Right.
Okay, so I think we are live right now. Avinash, are you there? I don't see you. Okay. So guys, let's go and get started. Maybe Avinash will join in later. So welcome everyone to the second iSPIRT OEQ, which is the Open Ecosystem Question session. We have a very interesting topic today, which is why do small M&A exits matter? Right? What is the big value of small exits? It's so interesting that in the startup world, when we look at all the press, we only hear about the big exits, right? Google acquired Waze for $1 billion. Google acquired Nest for $3.2 billion. Facebook acquired WhatsApp for $19 billion. But studies show that 65% of VC-funded startups actually return 0 to 1x to their investors. Right? So 65% of companies are not good investments, and even of the remaining 35%, the return is actually relatively smaller. Only a very small, tiny fraction, 0.4%, are home runs. Right? Even Israel, we know that in the last 4 years, there were 88 M&As that happened. Two companies, Viber and Waze, accounted for 25% of all the deal value. Right? So given these statistics, the real question that we are going to talk about today is, why do we promote this myth of a multi-billion-dollar exit? Right? Should we spend some time recognizing the value of smaller exits? Right? What do smaller exits mean to this ecosystem? And to do this, I think we have a great panel, and I'm just going to quickly introduce the panel that we have. So we have Jay Pullur, who is the CEO of Pramati Technologies. Hi, Jay. Jay sold Context to Autodesk a couple of years ago, so he's actually been through a successful exit. We have Sanjay Shah, who is the managing director of Invensys Skelta. So Sanjay is also a serial entrepreneur, been through multiple exits. Most recently he sold Skelta to Invensys. Then we have Karthik Reddy, who is managing partner at Blume Ventures. Karthik is a seed stage investment guy, so we'll get some good perspectives there. Pari Natarajan. Pari is the CEO of Zinnov, which is a management consulting firm. He also sold a company called Talent Neuron to CEB. So he's also had some M&A experience. And finally, we have Vijay Anand, who is the CEO of TheStartupCentre, and it's a tech product accelerator based out of Chennai. So welcome, everyone. I think we're going to have a good session today. So Jay, I'm going to start with you, right? So let's talk about just exits. Why are exits so important, right? Why should entrepreneurs care about having an exit? Why not just run a lifestyle business?
Yeah, so the way of looking at starting businesses has changed. Traditionally, Indian companies have been looking at, I start a business, maybe it's a trading business, I stay in the business forever, and I'm probably putting all the money which is required to really grow the company and keep it alive. Right? So that model has now changed into a model where you bring in external capital. The capital required for starting a business is higher. The entrepreneur is not putting all the money, neither it's a family inherited business. So in which case, the capital needs to come in a rapid shot. So which essentially means that there are external investors who are going to come in, and there is a tentative plan as to how much and when they could expect a return back. So if we were to put our money in some other business, then we have to be sure of as to what we are going to expect from that. And that has to be higher than what is possible outside in the market, so to make it lucrative. And also compensate for risk. If I'm taking the risk of putting money in a company as opposed to putting money in a bank, and if I just get the bank returns, I'm not going to be happy. So obviously, my expectation on return and exit is important. So that being said, M&A is a good way of exiting. It could be a profitable M&A, a huge home run. The valuations gains are very significant, or it could be a reasonable one. Things are not going as per the plan. There is a reasonable exit which compensates. So M&A is an alternative to going public and actually making the shares of an investor liquid. So I would say that entrepreneurs understand that these days, primarily that they need to provide an exit for investors, and investors invariably ask, if I were to enter, how would I get out? So without, I'm sure there are investors on the panel who could also add to it.
Okay, so it sounds like Jay, it helps for an entrepreneur. It really helps. You're lowering your risk by having, like what you said, risk capital from outside. But now the moment you have external investors, it's now then they're going to need an exit, right? The reason why they're putting money in your company is they expect an upside. That's the only reason.
Yeah, there is also another reason, which is employees who take stock options need to have some value for their stock, and they need to encash that. And probably an exit provides an opportunity to set a value and also get the money which is required to distribute to the employees.
Yep, so there's upside for the employees there too. Okay, so on that note, let's go to Karthik. So Karthik, you're a VC. Right? How do venture economics work? What does a VC expect to get at the end of the day, and how do small deals? What does a small deal mean for a VC? A small exit.
Small exits, yeah. A remarkable statistic I got to hear from an LP in San Francisco, a potential LP rather, somebody who's a seasoned venture fund investor. So he says, let's say you have a Series B fund, a Series A fund, and a micro venture fund, and let's say that we invest 15 companies, 25 companies, and 50 companies, 50, right? Like something like what we do. And as you know, micro ventures kind of becoming an accepted form of investing with large number of companies. But here's a bizarre statistic, right? So he says, irrespective of the stage or the asset class, the one remarkable consistency they've seen in the top decile or top quartile of performing funds over 25 years is that 4 or 5 or 6 companies at most deliver 75 to 90% of all returns in the fund. So you're still, there's a classic conundrum of whether you can build out reasonable sized exits systematically, or do you play for the home runs and continue to play for the home runs? So I think what you tend to see in the outsized returns, the Axel fund which played Facebook, for example, or perhaps the Sequoia fund which played Google, where you have really outsized returns come from really outsized outcomes and absolutely brand new ideas, right? And the reason why a good, 3/4 of venture funds tend to underperform the market, arguably is because they either don't take too much risk, or arguably that particular segment of the venture market is actually overcrowded, which means they're taking relatively safe bets or bets that cannot become home runs, right? So it's a little bit of a curse of the or the nature of the venture ecosystem to play for the home runs, right? And I don't think that's going away in a hurry. We thought we'll be a little different in the sense that we thought we will see to that a good number of our companies get small M&A outcomes, right? And to answer your question, it does move the needle if there are such outcomes. The challenge we have seen with India is that Indian buyers or acquirers are fairly stingy and skeptical of buying other assets, right? And so that basically means that you're not getting the desired, return back to the investors, even in the case of a small M&A. And that limits your potential options to a cross-border M&A, which, if it's a pre-Series A deal, even the cross-border guy thinks he can get a bargain, and it's typically for talent. It's not for. It's sometimes, very rarely, for market access. We got one acquisition where QCell was bought by Tofu, but basically, even there, the needle hasn't moved so much that you're going to get, let's say, a $20 or a $30 million acquisition, unless perhaps a few more $1 million of Series A capital have gone into the business, right? So effectively, from a micro venture fund which doesn't see a company through to Series A, it seems like very unlikely that you'll get an acquisition beyond a $5-10 million point. And then one has to question, does it meaningfully move the needle for you in terms of returns? So I think, there, for each fund, for a micro venture fund, I think a nice outcome is $20 to $30 million as a small M&A. For a Series A VC fund, I think it's more like $40, $50, $60 million outcomes. And for a Series B fund, it will be even higher probably. There were some murmurs of discontent when RedBus happened at the value it happened, even though it was a fantastic, M&A story. So, so the challenge is who you're asking. Right? If you ask a small player like us, small M&As make sense. I'm just, 3 years later, I'm a little wiser and skeptical about whether they're going to come as fast and furious as we want them to, and whether there are enough buyers for sub-$20 million assets, where unfortunately a lot of our companies might get stuck if they don't get Series A funding. And do they move the needle? They do. To summarize the point, I think what's very interesting in venture funds, a lot of people don't know, is some of the times we can take exit money in the first 2, 3, 4 years and redeploy it into the winners in the 4th, 5th, 6th year, right? And so in that sense, they allow some of the cash flows that come back to go back into the winners, and therefore give some liquidity in the interim, which actually helps. The second, I think, is the talent and which gets either absorbed into the big company or arguably into one of your portfolio companies actually ends up becoming even more loyal to you as a fund, and hopefully will deliver a new startup to you when these founders get out and build their next startup in Fund 2, Fund 3. So there is value in definitely playing this asset class. Unfortunately, it doesn't move the needle significantly. It contributes very little to overall fund returns. But it does build momentum, and it gets the company out of your radar. Right? You can't keep managing the company for 5 years, 7 years. So you see a quick churn of both your management bandwidth and capital.
Okay. So, Karthik, I think that was good. So I think you said it very well that typically, as a micro VC in a micro venture fund, you invest in, let's say, 50 companies, and statistics say that just 4 or 5 of those companies are going to return close to 90% of your returns. And so the question is, the remaining 45 companies are not going to do that well statistically. So even if you had an exit there, one big advantage is that you can then take that money and then roll it back into the winners, right? So that's something that he said, which is very valuable. So, and this is something we've heard multiple times, even from Paul Graham at Y Combinator, right? He said that the venture business follows the power law, right? And the power law says that for every big exits, there have to be multiple small exits, because the small exits then feed the bigger exit, right? From multiple angles. So it's interesting. Also, just to level set everyone, in the US, right, when we talk about numbers, a small exit in the US is like $100 million, right? Or below 100 million. And a medium-sized exit is like 100 to 400 million, and above that is a bigger one, right? And the $1 billion plus are blockbuster exits. In India, the numbers are still debatable, but we tend to think of 20 million and below as small exits, and 20 to 50 as medium, and 50 to 200 as large, and then blockbusters. Right? India inherently is going to be lower. So now let me move to Sanjay. So Sanjay, you actually went through a small exit, right? You actually sold your company to Invensys. So tell us, what did this exit mean to you? Right? What happened to the money? What happened to the employees? How was that turned around?
Okay, so just to give you a little bit of a background, I've had three exits, and the first one was a rather small one. We were very young, made a lot of mistakes, didn't even know how to raise money, and so we didn't raise any money. And the exit was consequently small. It was a fulfilling exit, but a fairly small one. In the next one, we raised a lot of money. And then while we did have a reasonable exit, because of the fact that we had raised a lot of money, the exit was not very meaningful. In the last one, the Skelta exit that we talked about, that you introduced me with, while there was a sub 20 million exit, I think it was a very fulfilling one. We had raised a very small round, and we were just a few of us, and therefore I think it was a very meaningful exit for us. So the question is, what did it mean for everyone? I mean, I think as far as the three of us, the founders are concerned, one of them was my wife, so she and I were a significant part of the company, and therefore, took the lion's share of the acquisition. But I think it meant a significant bit also for the employees. I think we had shelled out a fair bit of ESOPs to everyone, and I think everyone did very well. What was very fulfilling is that at my last point that I'd taken, we've got at least three other companies that have kind of been created out of the employees that we had. And I think the passion that we were able to generate through the running of that company for the last 5 years, for the 5 years that we were running it ourselves, was enough to entice a lot of the employees to start thinking going entrepreneurship way. And I think that was very fulfilling. So that actually happened. So yeah, I mean, I think from that standpoint, it was fairly fulfilling and significant.
Yeah, so Sanjay, I think you said that really well. That I think a couple of things happen when you have a small exit, right? It sounds like one was, in your own case, you had three different. Sorry, one second, I just lost my connection here. Yeah, so you had three different startups, and each one of them. So you had your first startup, you exited that at a low amount. Then that gave you some capital to start the next company, and then when you sold that at a higher amount, and then so on. You kept kind of going up the value chain. And secondly, in every exit, especially the last one, your employees who participated in the exit, they went off and started their own companies, right? So it's a great reason why smaller exits are important, right? Because they allow the next bunch of entrepreneurs to start out and start their own companies, then have exits too. Right? It's a multiplying effect.
Right, absolutely, and just to add to that, I mean, there could be, we possibly had a longer runway, and we could have continued on and maybe waited for another larger exit, but it was getting to be dicey. I mean, the field was fairly competitive, and therefore it made a lot of sense to exit at the point. And today, of course, in terms of what I'm doing next, is I'm actually transitioning out of Invensys and then starting another startup. So. Of course, it has given me enough and more money to be able to start another company without having to go out and beg, borrow right away.
Once an entrepreneur, always an entrepreneur.
Yep.
Yeah, and that's very important. And so, Jay, you went through it wasn't really a small exit, but just tell us about, in terms of, reaching a valuation, reaching a decision in terms of being able to exit. What was the thought process there? I mean, did you fairly sold at the right time? Should you have waited longer?
Yeah, okay. So I have gone through multiple exits. So I have done sub 20 million exits as well earlier. And this one was a little larger than that. So in case of context, this is a medium size exit. Like what we felt was this was the right time to sell. This was the right opportunity to sell. Because what we had done was we had put the money which is required for building the product and taking to some customer base, but not put enough capital to really scale and build a huge revenue base. So since we had not invested that money, it was right time for us to exit. Either we put that money and then wait for an exit a little later, or we take the exit now. So it was a profitable exit, it was a good one, it was good for us, good for employees, so hence it was the right time. And also, one of the things which I keep saying to people when do we know whether this is the right time to exit? Should I just continue along, or should I just exit and impact what is the status as of today? So most of the time, the entrepreneurs and the investors who are deeply involved in the company, they know it. If you are sitting in the rocket, then you know you are sitting in the rocket and you are not sitting in an airplane, right? Just you have to look out of the window. So in some fashion, you know whether you are zooming and there is a huge market which is unfolding, and then you need to pour in more capital and grow it, or you need to take an exit. So it is kind of becomes an obvious point at some point. And if you don't read that, the other danger part is that the one who doesn't read when is the right window to exit, he ends up not getting an exit. Just because we want an exit and we believe this is a good business doesn't mean that there are buyers for it, right? So there is always a window. So if somebody doesn't sell out in the window, then most likely all the others have purchased companies which they wanted to buy, and hence there are not enough companies to buy. For example, in the year we sold Context, this was in 2012, in a period of about 6 months, there were 5 exits in enterprise social collaboration. And after that, there were hardly any exits which were worth recalling, So obviously, it was a huge window there, and the buyers, moment they see that, oh, I was targeting to buy this particular company, and since somebody else bought that, I need to be quicker to buy another company. Otherwise, my options are going to dwindle down.
Yeah, I think it's a great point that every startup, there is a window of opportunity, right? Where you are viable, your valuation is probably higher, right? You are probably very competitive, and that is the best time to sell, right? If you if you wait too late, then you're going to miss the window. There may be other competitors. The market may have moved on, and you may not get any exit, right? So many times, I think a small or a medium exit is better than no exit, but people don't. A lot of entrepreneurs don't, and it's not that easy to time the market, obviously. So it's fast. Okay, great. So let's move to the next topic. So I'm going to now move to Pari. So Pari, you had you've been an entrepreneur for a while, and you had a very good exit with CEB acquiring Talent Neuron. Now let's talk a little bit about acqui-hires. Now I know that Talent Neuron was not a classic acqui-hire, but in the case of an acqui-hire, you have the deal is really to get the employees, right? It's to retain the talent, and typically in such a case, you get the talent gets the employees get a nice stay bonus over 4 years. The VC doesn't really make a whole lot of money, but it also takes the employees out of the system for 4 years, right? So what do you think in general about acqui-hires? Are acqui-hires good? What does it mean for the ecosystem?
Sure. So just a context. We are a consulting company. The way we thought about incubation is a lot of problems. What we are getting from customers are repeatable problems, and level of data usage, public sources of data we're using for driving insights is also increasing. So we said, why not automate the common problems and provide a subscription offering to customers? That's really how we started. We built out Talent Neuron. So coming back to your question in terms of, I think it's not just acqui-hire, right? Even a company is bought at whatever price point, even for the IP. And one level, people value the people who created the IP, and they want the people to stay with the company. And even not in acqui-hire scenario, even if the people are hiring for IP, it is very common for the acquiring company to interview people and see if they are fit into the company. Only then they buy the company. So I don't think just employees getting a 2, 3 year, 4 year time is just for acqui-hires. It's even for a scenario in a scenario where they bought Talent Neuron. Some of the key employees has to stay there, and part of the cash was tied into the key employees staying there. But I mean, they really own the IP in some sense. And I somehow think it's great for the ecosystem. because in our scenario, the team which got bought over is joined a much larger company. And one of the issues we have, in especially in smaller companies, to look at how do you scale an idea? What is required in terms of process, the kind of people you need, and the network you need. And now, if the same team is able to scale the product within CB, it gives us tremendous amount of experience. When they come out, they can go after much larger problem space because suddenly they have cash, plus also experience of scaling out a product with a larger company. And that allows us, and could be multiple people, the people who are coming out of Talent Neuron would potentially start multiple companies and who can go after larger problem areas. So I think the key 2 points are it's not just with acqui-hires, talent is going to go even from an IT perspective. And I think the talent working in a larger company coming out gives them a level of experience which they would not have got in a startup.
Yeah, I think so. So definitely, you're right. I think in any acquisition, I mean, I myself on the buy side when I was with Intel, I've worked on multiple deals, and invariably you want to retain the key talent. And so in any acquisition, not just acqui-hires, you will have a retention package or an earn-out or a stay bonus for most of the key employees, if not all of them. Right? And that's very true. And I really like your the other point you made that when an acquisition happens, the employees are now part of a much bigger company, and they have the opportunity to learn how to scale the business to maybe globally scale it 4x, 5x, something that they may not have been able to do if they had been by themselves. Right? So it's a very interesting experience. And again, another interesting value of a smaller exit. Right? So even though the exit was smaller, the employees then go to the bigger company and then they're scaling the business there. And it's much bigger than what they could have done before.
Right. And also smaller exits are, it's great. So if you look at the amount of money an individual needs to have, you need a house, you need to have, college fund for your kids, all of that, right? And between the 30 to 40, a lot of people get constrained by those issues. When you're able to take care of those, and you have the experience of running a company, suddenly the kind of problem you can go after is just completely opens up. And I think that's why the small exits are important. Like what Sanjay mentioned is you just keep going after larger problem areas. The basic needs in your life is taken care of.
Yeah.
Well, and Pari makes an interesting point. So the smaller exits doesn't have to mean smaller value for either the entrepreneurs or employees. They might make handsome money, in the process, which they would not have made, if a company had made $100 million and sold at $110 million, so probably they're not making enough money. So obviously, smaller exits depends upon how much of money is actually gone on. And so the employees should look forward to the experience and some return. And every acquirer anyway puts in some kind of an acquisition retention package.
Yep.
Yeah, and I tend to agree with Jay on that. I mean, oftentimes the larger exits also come along with a lot more funding that is raised, and therefore the promoters pretty much lose the company out to the VCs and the rest of the world, and therefore you make a lot less. But of course it can go either way.
Yeah, very good point. So theoretically you could have a company that's raised given up 90% of their equity to their investors, and even though the exit may be larger, the amount of money that the employees get is still not that great, versus you could still have a small bootstrap company that had a small exit, but all the money is with the founders and with the employees, right? So you're right. That's a very good point there. Good. So let's move to Vijay. And there's another interesting point here. So Vijay, you see a lot of startups, and as part of your the accelerator. In terms of exits, now, do you feel that we as a nation are too focused on US acquirers, having a Google or a Facebook trying to come to India and buy startups versus looking either within India or looking elsewhere in Asia?
So I think this is a conversation that we've been having with within NPC and the iSPIRT group as well, right? So I think today when we're building a company in India, we are looking at a Google or a Facebook coming and buying it for the same reason that Karthik mentioned, right? Because ideally the buyer who's coming in India and making an offer is essentially looking at, here's a 5-people team, look at their salaries, put a 20%, okay, there is something going on here. Okay. Hello. Okay. So they're essentially putting a 20% premium on it and basically saying, you know what, that's the offer that we actually put on the table. It's not even millions. It's usually speaking about, you know, either in lakhs or in crores. And I think that's what the entire, you know, either the team doesn't want to basically quit or basically the investors say that there is not really a good deal that's happening here. But I think that all said, I don't think that so far there has been any effort that, you know, we can actually go after the top 100 companies in BSE or NSE, kind of come to understand what are their Horizon 2, Horizon 3 plans, and basically figure out at some point technology has to make a difference to some of these companies, right? So where does it actually fit in? The average entrepreneur today also wants to get acquired by Facebook because it's not sexy to say that you got acquired by ONGC, right? But it's nice to say that, you know, I got acquired by Facebook.
So yeah, so there's a pedigree attached to being acquired by, you know, Google or Facebook that you don't get that by being acquired locally, even though the valuation terms may be better.
Yeah. And I think, you know, from a perspective of ecosystem building, right, you're also shipping all our entrepreneurs and our IP abroad. It would be great if some of this IP actually remains here.
Yeah, so that's interesting. So you're saying that, you know, from your perspective, you feel that there is one of the downsides is that of a Google or a Facebook or a US company acquiring an Indian company is that the IP is moved out of India. Although again,
side effect. I don't think we're taking a patriotic case here, but I think, you know, from a long-term ecosystem building perspective, I think we need to keep that in mind, right? One of the other things is also that I think I see a lot of, so, you know, of the most teams that we actually see here in India, I see very few teams which are actually building the kind of IP or the patents that actually the US buyers are actually looking for, right? That doesn't say that any of these teams here are actually lower in quality by any standards, right? There might be a 50-people engineering team probably giving the same output as an Instagram, which is probably built by 18 people. But the value of both companies are perceived very differently.
Okay, so that's another point. So, Jay, you in your case, when you sold Context to Autodesk, you know, just to Vijay's point, now that case was slightly different, right? The IP didn't move out of India, and in some cases, in fact, Autodesk used this opportunity to open up an India office. Is that correct?
Yeah, they open up an India office. Yeah. So actually, whether IP belongs to whether it resides in India or outside. For example, we are at Pramati. We are trying a different model. You know, one of our newer model is we own the IP in a US company, but is actually held by Indian owners. So Pramati is an Indian company which holds a US company which holds the IP. That's a new model. You know, that's a, you know, not a very comparable example would be like Tata owning Jaguar in UK, let's say. So here it's not the IP which is owned, but the IP whether it's valuable or not. So one needs to increase the value of the IP. Obviously, as we said, you know, one would settle for a medium deal if large is not possible, and would settle for a small if medium is not possible. If small also doesn't happen, then probably we will get for actually happen. So we know where probably things are going, and obviously companies have to work towards building the company to the extent that it competes in the market, and in that spirit, you know, that's the spirit which builds the capabilities of the team as well. The value of the team goes up as well. You know, more competitive the company is, more they have tried out in the market, whether they were successful or not. So there's still their value goes up. So the question which to ask again to Vijay Anand would be: is there a premium attached to a company being acquired by somebody in US as opposed to India? Given the value of the deal the same?
You're saying that is there a premium attached to a company being acquired by the US?
I know employees would talk around, we were acquired by so and so, that's a matter of pride. But
Yeah.
is there a brand value for entrepreneurs also or not?
It is, absolutely. There is absolutely, right. I'm not denying that at all.
It's some kind of viewed as some kind of validation.
Yeah, it is, right? So the same reason as why entrepreneurs basically look for funding, even though I believe that 80% of the company. See, in India, I think it takes longer to build value. It fundamentally comes down to that. It will take 5 to 7 years before you figure out what product you're building, because the best people are not working in startups today. You basically have to hire people with potential, groom them up to basically start building a team. Unless people in the US which are hired at $100,000 engineers, people are basically coming in at $10,000 an engineer here. So obviously it takes time. So I would absolutely agree with Karthik, right? So early exits are brilliant. If it happens, I don't think anybody is in the way. But I think today there is way too much engineering required in basically some of these exits happening. Like Andreessen Horowitz is actually a 45 people team today. Karthik and people like us are 5-6 people team today, right? So are we going to manage the fund? Are we going to talk to entrepreneurs, groom them, or are we going to basically be engineering their exits?
Yeah. So sorry, I just wanted to interrupt very quickly. So guys in the audience, for those who are listening to this, if you have any questions, feel free to post it in the chat window, and we'll try and take those questions. I don't see any of them right now. I'm not sure if I have to open up.
There's an 18 plus.
Yeah. So I don't see anything else here, but please feel free to ask questions, and we'll try and take those before we end this call. So now, Vijay, going back to your point, so we've agreed, I think, today that small exits have value.
Yeah.
We know that in general, it's harder to sell your companies to a Google or a Facebook, right? It's much harder. There's a discovery challenge. There is those companies aren't necessarily looking to come to India and look at the India market, etc., etc. What other than the sexiness of those companies? Or the credibility that you get. Are there any other reasons why Indian companies haven't been acquiring Indian startups?
I think there is a valuation problem, definitely, right? Because a lot of these guys today, so even when they acquire some of this technology, they're looking at it as Horizon 2, Horizon 3. So this is a question that basically bums me out every time, right? People come to me and tell me one web entrepreneur who's basically built a successful company that I want to be mentored by. And I'm basically scratching my head most of the time, right? I basically Deep Kalra, pretty much everybody is here in this session and probably the last session that happened. It's still in two hands, right? So essentially these are the 10 people who probably need to acquire these companies. There's really no other buyers who actually put a premium on technology today. And I think that's probably one of the first things that's driving it. Second thing, I also think we need to start looking at markets beyond the US. I think we need to start looking at what's happening in Japan and China and stuff like that, because I do see a very strong hardware component happening there. There's not a very strong software component happening there. So perhaps, the Indian assets basically will make sense, because for them it would be it's a solution that makes sense today, not a Horizon 2, Horizon 3 plan. Even when we go to a services company which actually has a budget to buy it, they're basically the products might be something that we want to get into, right? It's really not something that they want to invest in completely.
Yep. So I think there are three different challenges, right? Sounds like there's the services companies, clearly there's it's a different DNA, and there may not be a product fit.
Pari might have a view on that. Services is not buying a product company.
Yeah, and actually, we are starting to see that change. We expect some of the larger companies, like Vishal Shikha coming into Invensys, will definitely drive Invensys to make some interesting acquisitions in the product space. Hopefully, when that's from the India ecosystem. The same with something like Cognizant, is focusing on Horizon 3, which is largely going to be based on IPs. Right? Every large IT services company is saying that IP focus and improving productivity of their engineering focus is going to be important. So we see that is going to be one area.
Yeah.
Even in the US, forget about Google and Facebook, a whole bunch of other companies want to be like Google, and they can't access the startups in the US because it's way too expensive for them. for them, India could be a great location, right? The company, it's not very well known. They're probably based out of Midwest. They're based out of East Coast. They can't access the Silicon Valley startups, and India can provide a very good opportunity for them to look at companies. The third set of companies are really large enterprises, right? Take it Visa, American Express, Verizon. A lot of these companies are getting disrupted by the software companies. The Google is disrupting Verizon's business, or Amazon is disrupting Target's business. All of these companies are looking at how do I become a high-tech company, and for them, there are lots of interesting acquisition opportunities out of India we can potentially create. So those companies is what I think as the ecosystem we should go after, not really a Google or Facebook, or every single Silicon Valley company wants to sell to Google or Facebook.
Yeah, exactly.
Yeah, so it's a very good point. So Sanjay, you sold your company to again, not one of the big Yahoo, Google, Salesforce guys. Right? You sold it to Invensys, which is a company. Again, the people you were talking to were based out of Texas. Right? How did that work? And what would your advice be to other entrepreneurs? Was it easy for you to get covered? Easy to work with them?
So yeah, I mean, I think from a standpoint of easy to work with them, yes, very, very easy to actually work with them. They were a great company to work with. They were very fair throughout their dealings, and it was a fun ride. I mean, I think had we not made our earnouts and all of that, it would have been a little bit difficult. But I think they made us. They wanted us to get the earnouts. They wanted us to do the right thing. So. So that was that side was pretty good. I don't think it would have been any different from what Google and Facebook would have been. But we really enjoyed our 2-3 years that we had with them. From a standpoint of how we got discovered, it was purely luck. It was purely happenstance. I mean, I was the story. I was in the US and they just happened to call me. It was a sales call, and it just turned into an acquisition. But I think what was very important for us was that our credibility was through the only credibility that we had was our website, because we were a complete remote organization, didn't have any feet on the street. And it was important that we sort of showcased ourselves really well on the web. And in fact, they found us through the web. They were looking for a BPM company to embed into their software, and then that's how they found us.
Okay, Sanjay, this is an interesting point. You had the experience of approaching Invensys for a sale, and it ended up in being an acquisition. I had a similar experience as well. We went to Autodesk for partnering, and it ended up in a sale.
Right.
Coming back to Pari's point, why service companies are not acquiring, the Indian service companies are not acquiring Indian product companies, is because they don't engage in other business relationships. Normally, an M&A exit is not as much as going to a supermarket and buying, but actually is a relationship which actually matures enough to become an M&A of some sort, right? So, if Indian service companies start working with Indian product companies and startups, then probably they will find that this is worth acquiring, and then probably if this were in our hands, we would do something else. And the acquisition materialize. Pari, what do you think? You agree with me?
Yeah, I absolutely agree with you. And we start to see some of the large Indian companies starting to work with startup accelerators. They are involved in many of the startup initiatives. As they work with them and take these startups to their customers, and the customers start seeing value, then they definitely will acquire. And each of the large Indian companies work with at least about 40 to 80 large companies where they have $50 million plus deals. So the level of network what they have to get these companies to the large organizations, especially B2B startups, is humongous. It's just that they currently don't have an internal structure to look at these startups. The business units are going quarter on quarter. They're measured on revenue they bring in and the margins they make. They can create a structure which kind of looks at the startups, engages them, and takes them to the business unit, shows it to the customer. Then automatically, after they do the initial engagement for a year or so, there could be interesting exit possibilities.
So it is their public status which is kind of doesn't accommodate
Correct, because all of them are measured on quarterly results and they just purely focus on chasing RFPs.
Yeah.
Okay, guys. So there is a question that from the audience, and I think Avinash just posted it on the chat window. I'm just going to read it out. So it's actually a very good question. So we've established that small exits are good both for entrepreneurs as well as for the investors, right? But why is this? Why are they crucial to building a viable product ecosystem in India?
That's a good question. Can I take that, Sanat?
Yes, Jay, go ahead.
I'll give you the first answer, but maybe there are multiple answers possible.
Sure.
The first answer is an exit is an event which truly builds risk capital available in the ecosystem. So whatever was invested originally, let us say can be considered as the principal, then whatever you earn out of that is easier to take a risk on. Yeah. So obviously, a good exit builds risk capital into the ecosystem, and hence more things can be done. So for example, Sanjay's point, where he sold one company, he started another one. He could do much more than what he could do in the first company. So obviously, the money which is made out of the exit is not going to go into the bank and stay there, but is going to come back into the product ecosystem as new ventures and new investments and so on and so forth.
Also, to add to Jay's point, I think what tends to happen is that the kind of passion that it creates when a successful exit happens, it drives a lot of the other employees to go the same way. And like I was telling you, it happened with several of our employees. So I think all in all, that certainly drives a lot more entrepreneurship into this entire equation.
Yeah, I agree with Jay. The money goes back into the ecosystem. We have already invested in 2 different startups. We have done angel investments post our exit. I think there's more and more companies would do that, and it's really good for the ecosystem.
Yeah, that's right. And also for employees, for example, we made profits on exit, so we are able to give bonuses to them. The ESOP made sense to them, and hence the employees also see some money coming into their pockets, for all the hard work they put in. So obviously, it is very interesting for employees to see that exits happen.
Right, and I think just to add to Jay's point is not only does it for the existing employees of the company that gets acquired, but even for the outside world, the outside ecosystem, when they see exits happening and their ESOPs becoming meaningful, it makes it a lot more meaningful to get ESOPs. And that's what again drives the passion of the employees for the next venture that they have.
Yeah. So I was telling, I think in one of the discussions we were basically saying that if a couple of exits start happening, I think that solves half of the problem with the ecosystem, right? Yeah. Suddenly you basically say, hey, I'm not getting great employees to come work for a startup. That goes away because great guys basically start preferring working for startups, as Sanjay said. It really, really changes the game.
Yep. So all great points, guys. So good. So we only have a few more minutes left. So what I'm going to do is I'm going to go to our last question, and I think Karthik will maybe have you start with this one. So just to bring everyone back to the original point of the debate, which was how important are small exits, right? And I think we've talked a lot about small exits matter. We know that this is the moment you have a small exit, then it brings more money to the ecosystem. Et cetera, and then those people start their own companies, etc. So Karthik, I wanted to talk a little bit about expectations, right, of small exits. So if you look at India, we know that roughly 35 or 40% of the product companies are B2C companies, predominantly looking at the India market, and then maybe another 60% are B2B companies looking both local and global. Now, we also know that historically the B2B companies, their valuations tend to be higher, but M&A is a lot harder. The B2C companies, the ones focused on the India market, right? E-commerce companies, the classifieds, etc., the travel portals. Is that a winner-take-all market where you have one big guy and everybody else is small? And if so, what should those other guys be expecting? Should they be expecting to go through a small M&A? Karthik, are you there?
Karthik, we can hear you.
I think it's also yeah. So it's also a function of I think the depth of investing niche in the United States market. There are arguably 5 or 10 guys chasing that opportunity and investors to back up that opportunity. You take parallel of in India, and it becomes very difficult when one leader has been funded. And if the market is happened inside travel e-com, and to some extent in goods e-com, of course. But those momentum sectors sometimes are able to draw investments into niches as well as the market leaders. But it's not very common that you see the Indian VC community, given the size that it is, actually take bets on the number 2, number 3 very easily. It's especially if there is a big gap between the timing between the number 1 breaking out or getting a big round of funding. So I think capital in itself is becoming a sort of a competitive advantage in some of these deeper consumer plays, which are on the ground plays in India, which are a little bit more asset heavy or capex heavy than, let's say, an app or something or lighter in terms of capital requirements. So it's when that happens, and recall has happened between the first 2-3 players, immediately next 2-3 years cycle disrupt them because there isn't enough capital available from the VC market. Right? It takes a cycle of that maturing to then find who can come and disrupt a particular vertical or a segment of that, and then you see the next round of seed funds like us or accelerators or startup centers basically finding gaps in the other market and then building the next wave of startups in the space. And that I think is the challenge in anything that's produced and which people then say, oh gosh, there's a market leader, why the hell is nobody else? So broadly, because also the guys who are market leaders can rake up so much cash from the market that they could easily overshadow the startup's idea or niche in that space. That's my take at least.
So in the again, just going back to the B2C, the consumer companies, the ones who are market leaders, it becomes pretty obvious at some point that okay, there are these guys, there's a Flipkarts of the world who are market leaders. Should the smaller entrepreneurs then expect that hey, this is an exit for me. I should be going and trying to sell my company to the market leader. That's really the only exit of opportunity here.
Yes and no, in the sense that, so I've had a chance to have a chat with Nishant of Flipkart recently. So, so what happens then is these guys become very focused on, not sometimes very quickly and sometimes it takes some time. So you look at Book My Show, Flipkart, arguably they're all in the market for small acquisitions, but they're very focused on what they want to buy. They won't buy something which is necessarily something that they can expand into fairly easily by hiring 3 people, right? If it is something which is complementary to what they're building or an extension of the product platform as opposed to just going and buying customers, they might be more willing to do that because they know that they have the marketing skill higher, arguably better talent. Flipkart, I'm sure, is keen and looking on a few spaces. Book My Show, I know, has spoken to a few players in the market. And I'm sure they'll make advances. And because the gap is so much, it makes sense smaller companies to say that, we'll be probably better off learning. Like, I think Jay brought up this point that there's a massive company that you're going, whose umbrella you are. And there's so much learning to be had with data analytics of, 10 million visitors a month or 2 million visitors a month as opposed to your 10,000 customers a month. And you can take that learning, get acquired by one of these companies, step back, step out of the company 3 years later and then go build your next startup. So I think small companies should look very quickly at something if you can.
My view is, the company should not be created with exits in mind. Company should be created with looking at adding value to customers. and exit happens on the way, so be it. So the entrepreneur, if he's building a company thinking of exit, and I don't think that's the right way to build a company. You build a company to add value, and then exit will happen.
Yeah, I agree, Pari. Definitely, if the whole software population wants to be acqui-hired, then there is not going to be any value for them. So obviously, even an acqui-hire requires that they played a competitive game. Maybe they did not win it, but still they have the spirit of winning and they know how to really do the competitive product. And that's what is going to be the valuable part. Yeah.
Great. So, guys, I know Savinash just reminded me that we are out of time, right? And there is one more question about how is iSPIRT helping startups in M&A? And I think what I'll do is we'll try and take that offline and answer it as part of the blog. So,
2 sentences at least.
yeah. So what we'll do is we'll after this session, I think we'll do a quick blog post with some of the key points, and we'll also have Avinash will also post this video online. Okay. So guys, I think it was fun. I think we had a good session. Thanks very much, and look forward to the next one.
Thanks, Avinash, for organizing.
Bye. Bye.
Bye.